Well, it has been an interesting week in real estate and mortgage. In case you haven't been following along, there has been so much going on this week, like action packed. There actually was a lawsuit that 1.78 billion was awarded to 500 homeowners in the Midwest, stating that realtors had actually conspired to raise the commission. And these homeowners didn't understand. Maybe they did understand, but at the end of the day, they decided that it was unfair that they have to pay a commission to real estate agents that represented buyers. However, they signed documents that clearly showed that you would have to pay the buyer side commission. So this is an interesting turn of events and how real estate will be conducted moving forward, as they're going to be using this actual case as a precedent. Many more lawsuits have actually been filed across the country as a result of this now against the other realtor associations in the county. The next actual case is about $5 million versus this 1.78 billion that was actually awarded. So it's still very shocking to me that a lawsuit was actually won based on emotion. However, I know you don't care about that. At the end of the day, I need to talk about how it actually affects you as a buyer moving forward. So right now it does not. We still have a structure in place that basically a buyer's agent is paid by the seller via what's called a co-broker commission. What could happen in the future is that they can ask you, the buyer, to actually pay your commission for the agent, or you're going to see that many more buyers will be working with the same company that is listing or selling the house, a thing that's called dual agency. This worked very much in the past, but it changed because many buyers felt like, of course, that agent was representing the seller's best interest and not necessarily theirs, and wanted to purchase the home. So just be very aware, mindful of that coming up. I'm sure there are going to be a lot of news headlines that put some spin on this. Their goal is for it to say protect the actual consumer, but I'm not sure that you protect the consumer by taking away representation. So something to consider as you possibly plan to buy a house in the next year or so. Now, of course, that lawsuit will be going back and forth to appeal. However, this happened to mortgage in 2014, and it forever changed how mortgages commissions were actually paid. And I think most of it was favorable, but I do think we're a scapegoat. So this real estate disruption is going to change how you transact business in a real estate transaction in the future. So with that in mind, speaking of the future, I think if you plan to buy a house in 2024, the time is actually now to work with an actual advisor. And I totally get it. Interest rates are anywhere from 7.5% to 8%. So as I said, that this has been an interesting week. What we saw last week was, rates ticked to an all-time high, the highest they had been since December 2008. Okay, so that is a long time for us to hit an all-time high of where interest rates actually were last week. So we were tipped up at about 8.125 for a 30-year fix. And of course, every scenario is going to be a little bit different. However, Federal Chair Jerome Powell did not raise the Fed funds rate. Now, I can tell you now, whenever he raises rates, that is not directly correlated to interest rates as far as mortgages are concerned, but it's a trickle-down effect, right? The overall economy in general. So what he said was he did not raise rates, and in his talk, it was pretty favorable. So we have actually seen rates take a slight decline. But I want you to get away from worrying about interest rates and worry about appreciation rates. And you say, what do you mean by that, Markita? So as we say, I'm sitting on the sideline to wait before I buy, waiting on rates to decline. You're also waiting on prices to go up. So there also was news this week that we're at a 20-year high as far as appreciation, even in what's deemed to be a housing recession, as Mr. Powell actually alluded to, causing a recession in housing. What did that really mean? It just meant that there were less buyers on the street because homes seemed to be less affordable. It did not cause a recession in the true sense of the word because people are still buying homes. So with that in mind, the appreciation of the home is possibly going to wipe out any big savings far as waiting on rates to decline. So do I think you should buy a house in 2023? Maybe not. But do I think you should have a buying plan in 2023? I absolutely do, if you feel like home ownership is in your future in the next 6, 12, even 24 months. So my goal or my advice to you would be to get a buying plan in place now, not necessarily buy the house now. So rates are going to possibly decline, but honestly, who can predict that? We cannot. But we can go with historic true data that shows housing prices are going up. So sitting on the fence, the cost of waiting may actually be real. You want to have a plan so that you are ready to pull the trigger when that time comes and not get blindsided. And the reason why is because when rates do drop, based on our supply levels, meaning the number of homes for sale, all these people that sit on the sideline and wait for this time frame while prices are going up are going to re-enter the market. But it's not like you can just all of a sudden have homes available for these people with the pent-up demand. So you possibly look at going from, one offer, 2 offers that you're competing with, anywhere upwards to 4 to 10 offers on the actual same property. And the reason I say that people will jump back into the market is there was a study by Bankrate talked that 74% of Americans still believe that home ownership is the American dream. And then part 2, another thing, part of the American dream was being able to retire. And I might be a conspiracy theorist in my thought process on this because I am involved directly with real estate, as you already know. But I think being able to retire comfortably, should I say, or with some type of retirement that, has a good quality of life, I think you have to have some appreciation in real estate. I think you have to have some ownership of real estate, unless you are a great investor in the stock market, which does perform well over time. However, even with that, you need to get started now. The cost of waiting to invest in either thing, because they are possibly long-term investments, the longer you're out of the market, the harder it's going to be. So what happens is time in the market actually will beat being able to try to make up those returns. So that just goes back to my thought process of, hey, even if the house was $400,000 at 8% right now, when you come back next year, November of 2024, that same house will be $420,000, maybe at a 6% rate. Who really knows? All of our rate prediction and forecasts for this year have been grossly off, just because our economy is coming off some grossly off events as far as the unicorn years in mortgage and real estate. The unicorn years I'm referring to are 2020 and 2021, where we had artificially deflated rates. So I'll say that in English. We had rates that were pushed down into the 2s and 3s on purpose by the Federal Reserve, and there really was no need for that. So you cause a hyper amount of demand, which also caused a hyper amount of appreciation, which caused people to actually buy houses and remove contingencies and different things from contracts, which we just never actually recommend. So I think for 2023, no, do not buy a house, but get your plan together and talk to a qualified mortgage professional that can advise you and not just give you rates and fees. So everybody's buying experience is going to be based on their specific scenario, but I believe the day of just walking into a bank asking for a mortgage and not looking at your overall scenario is not going to be very smart. When is the best time to buy? When you're ready, able, and have made a decision. That is my advice or my recommendation on when is the best time to buy. The best time to buy a home is when you're ready, you're able, and you've decided. Okay, so reach out. I actually have a free home buying guide here that we can actually send you, that talks about some different numbers and aspects of buying a home. So if you want a copy of that guide in electronic format, I certainly can send that over to you to take a look. I like to say, people lie, feelings lie, but numbers don't lie. They have no emotions, so you can take a look at it for yourself and not worry about whether I'm talking to you in this manner because I'm actually a mortgage lender. So that is some news that you actually can use. And another thing, I totally get it. If I was a home buyer right now in the market, would I sit on the side because of 8% rates? Possibly, because you keep hearing people try to compare 1988 rates at 8%. Oh, when I bought my house, it was 14, 15%. Okay, great, Betty, but that was 30 years ago, right? So let me give you some numbers, and this was posted by a friend, but I think it's worthy of talking about. An 8% rate in 1988 versus the 8% now is absolutely not the same thing. The average income then was about $32,000, 32, one of my favorite numbers. And in 1988, the average loan amount was about $100,000. So there you have it, right? 3 times the amount of income, far as the loan was concerned. Absolutely, home ownership, even though rates were 8%, probably made sense. So the average income in 2023 is trending at about $75,000. However, the average loan amount is up about $408,000. So that's 5 times that income. So it definitely makes it a sacrifice and something to consider about affordability. So yes, I'm never going to tell you that, oh, but you should still buy because rates are X. You should only buy a home when you are ready, able, and actually have made a decision. And part of that is working with a qualified mortgage advisor to help you walk through these steps and look at the pros and cons of each side. I will tell you these other small facts that I want to share in regards to home ownership, whether you're buying a home with me or not. The net worth for a homeowner is 40 times that of a renter. According to a latest survey, I want to say this was also by Bankrate.com. So the net worth of a homeowner is 40 times that of an actual renter. So the average American actually has a lot of their net worth, which is money that is you have in equity based on appreciation of owning real estate, is tied up in the actual home. So as I mentioned, 62% of people said being able to retire was one of their American dreams or goals, based on a survey from Bankrate. So I'd venture to say one way to actually help fuel that retirement would be appreciation of property or a home, real estate that you actually own. So I think those two dreams kind of go together and need to be looked at very closely. Another thing that, back to the 8% mortgage rates in 1988 versus 8% rates in 2023, when the prices go up like they have and the average loan amount is about $408,000, that also means the down payments. So unless you are a veteran who does not have a loan that requires a down payment, and we thank them for their service for that, that is a benefit, most people would need at least about 3% down to enter that market. So $400,000, that's $12,000 as a down payment. So that is another barrier to home entry or home ownership. The median down payment right now for first-time home buyers is about 6%. So even though there are loans with 3% available as a down payment, 6% of $400,000 is $24,000. So in these high times of inflation, you may not have that money sitting around, but you do desire to buy a home. Definitely work with a qualified mortgage advisor to come up with a plan and see what type of programs that you can actually use to still fuel your goal and fuel your down payment nest egg. I really am concerned overall that there is a segment that is going to get left behind as price appreciation continues to grow, and never be able to enter the market as a homeowner or enter the housing market as a homeowner and perpetually will be turned into renting. This is not fear talk. These are facts. So definitely want to see what your specific scenario is. There are programs in every county, it seems, to help. Some are more liberal than others. Most of the states do have some programs too to help curb that down payment, which I said is 3% minimum for a first time buyer. However, the average right now down payment is about 6% across the country. So check into one of those programs, and it will be a matter of what you decide is going to be important. And I almost feel like if retirement is something that's important for you in the long run, that you should possibly consider what you're doing with your housing, what you're doing with housing and where you are with this actual scenario. Another thing that I wanted to address, as far as some news that you can use, is that as homes have become more unaffordable, based on high rates and limited supply, and we're still having appreciation. It was very interesting. The beginning of the year started with that the housing market would decline in value, and in fact the opposite has happened. So what that means now is that we have to be more creative in how we help you enter the housing market. So how do we help you enter the housing market? We help you enter the housing market by being creative with possibly doing some multi-generational living. Yes, multi-generational living. So for the average American right now, some things are unaffordable. However, whenever we can pull funds together to invest in housing, you're probably going to get a bigger house, more house that will suit the needs of the entire family versus trying to go it alone. It seems to me that other cultures have figured this out. We are now just being forced to do so because single family housing for the single income earners are becoming harder and harder to do unless you are a very high earner in today's market. Kudos to you if you are. But multi-generational living is great. I believe our government, or pseudo-government, I should not say that, our government-backed entities that buy mortgages, basically, they are the back-end investors of the mortgages that are closed, have decided now they're going to help that be more affordable. So 5% down for a multi-unit property, whereas before that was 20% down. So perhaps we do multi-generational living in a multi-unit property and only have to put 5% down, but everybody's still able to have their space. We also have some news that ADUs, which are affordable dwelling units, are now being able to be built on single family lots. So that's a big deal, folks, that people are understanding that we are going to have to work together unless we want to become a country of perpetual renters, which I do not recommend, because you might be caught in the rat race. And if you plan to retire, you want to have some way to build appreciation or build equity over time that doesn't necessarily include your labor. Does that make sense? So a passive way to build appreciation, build equity by not having your time be traded for it is through real estate. The stock market also offers this same type of investing, and with each, you have to do it smartly. You have to have the right advisors helping you move in the right direction when embarking on something like this. But you know what? There are other benefits to multi-generational living, which actually include more quality time with the family, right? Quality time with the family. It's easier to care for loved ones that are getting up in age. We know that people are living much longer now, and there is a stretch sometime when the family has to come in and give some care. We don't necessarily want our loved ones in nursing homes and things of the like, so multi-generational family makes that easier to do. Again, keeping that sense of community also gives flexibility for maybe the family that is starting out and has younger kids, that there is some built-in help far as babysitting and different things, or just overall care. So I believe it just boils down to we're better together, and right now the family unit is going to need to be very strong and very resilient in deciding to have multi-generational living and making sure that there is something left or equity there for themselves and the next generation moving forward. So that is my spiel on multi-generational living, why we should consider it more in America. I do believe it's another avenue to help get into a home and qualify for more house, but also has some very non-financial benefits that are very, very tangible though. Have you all seen the cost of daycare? When my kids were younger, the cost of daycare was, both of them in daycare, in diapers, was a small mortgage, okay? It was about, I would say, $1,400 a month, and that was 15 years ago, right? 15 years ago, because my oldest just turned 16. So I can't even imagine what that cost would be now. So, there's some non-tangible financial benefits to actually considering multi-generational living as a way to own real estate and start to actually build wealth. So that's some other news that you can actually use. I also wanted to chime in with some local statistics that I saw from a realtor. Thank you for actually sharing. Alan Johnson with the AJ team shared some statistics about the local housing market, because many times the information that you receive on the news and national channels are just that, speaking to a very national level. However, real estate is very hyper local, and you need data that is going to calm down some of the drama about what's happening in your backyard. And his numbers were that Prince William County is down 28% year over year on houses that are being actually sold. Fairfax County is down 25% from 2022 to 2023. Stafford is down 28%, and Loudoun is bringing in the rear. They're down 26%. So why is that? And part of that is because mortgage rates have caused an affordability crisis somewhat. So the market is down probably a quarter in all four of those counties that I mentioned. However, the price year to date for each county is actually up. So Prince William County is up 3%, Fairfax is up 4%, Stafford is up 3%, and Loudoun is up 3%. Why do I tell you that? Because even though the sales are down, the prices are up, which might be counterintuitive to how a market would work with basic finance. So what that means for you is you cannot time the market. If your decision is to buy a home, you need to get in the market when you're able to do so, not waiting to time it, because based on this timing, you would think the home prices would be going down since the number of sales are going down. So just some more information for you to keep in mind. And when you're thinking about your home buying decision, I do have a free guide if you're thinking of buying a home that you can actually take advantage of. You can actually DM me and I'll send you an electronic version of this free guide that has some more data to kind of calm down the drama that's out here in these real estate streets. All right, thank you.